Good morning, everyone. Happy Friday. Another week coming to a close here. We have a short panel for you guys today. Alejandro is dealing with some medical issues, and Snipa is taking some well-deserved PTO out in Dubai. But let's introduce our only other guest this morning, Diamond Trades. Good morning.
What's going on, Mander? First dual Fed forecast, dual beat the bell. I'm excited. I think it's gonna be a sick one though. Because we got a lot to cover.
Yeah, we got a good one poised up today. So take it away with the economic calendar.
Well, no economic calendar today. We just had the only news today really is going to be NFP. So we just had NFP live. NFP came in today at 187,000 versus 200K expectations in the previous of 209,000. So below expectations are at NFP, and then unemployment came in at about 3.5% versus the 3.6% expected. Jerome Powell and the Fed, the FOMC, has constantly mentioned the tight labor market as a sticking point for potentially causing upward pressure on inflation going forward. And so that's a part of the market that we know that they watch, and that's why we watch it. And to see the job openings dropping slightly, obviously a good sign, but that unemployment rate still remaining stubbornly low at 3.5% versus the 3.6% expectation. So we'll have to see how that develops in the months to come. But so far, the market pretty muted reaction, particularly after the Amazon and Apple news that we got yesterday. The S&P, or the NASDAQ rather, is trading lower than the close, or basically right where we closed yesterday. So really not a ton of movement at all there on the NFP news. But let's go ahead and dive into some of the other news that we got this week, including the AMD earnings. So we got several large cap tech earnings this week, AMD being one of them. AMD reported top and bottom line beats on Tuesday on an 18% decline in year-over-year revenue while lowering Q3 guidance. So EPS came in at about 0.58 cents versus 57 cents expected. Revenues came in at 5.36 billion versus 5.31 billion expectation. So a double beat on the top and bottom line just narrowly. They guided Q3 revenues to the tune of 5.7 billion, lower than the 5.8 billion the analysts were looking for. CEO Lisa Su had positive comments on the company's data center business, saying, "We are expecting a large ramp in the second half for our data center businesses weighted towards the fourth quarter, and we are still looking at a zip code, let's call it 50% plus or minus second half to first half." So some bright spots there for the company, even though they did, like we talked about, have an 18% year-over-year decline in revenue, which actually really leads some of those large cap names. If you look at AMD, the price action has really been pretty weak. And if you're like me, you look at that and say, okay, well, that must be an opportunity, right? Why has NVIDIA run? Why has Intel been running all of these chip makers, but AMD hasn't? And I guess we got the answer to that question this week, right? Showing a bit of weakness there, not only on the revenues, but also on the guidance. The company reported second quarter net income of 27 million or 2 cents a share, compared with 447 million or 27 cents per share in the year ago period. So a massive drop there in net income. Adjusting for stock-based compensation and other one-time items, AMD reported earnings of 58 cents a share compared with 105 per share last year, same time. So a pretty stark drop there in year-over-year EPS. When asked how AMD will stand out against competition from the likes of NVIDIA in the AI field, CEO Lisa Su told analysts, "I think there will be multiple winners in this game, and we will be the first to say that there will be multiple winners. But we think our portfolio is actually fairly unique in the sense that we do have CPUs, GPUs, and we have the accelerator technology and Ryzen AI on the PC side as well." As in the embedded side with our Xilinx portfolio, Su said, "I think it's a pretty broad and capable portfolio." So AMD is essentially making the bet that even though they may not be the leader in some of the technologies that are currently propelling the stock prices of other names such as NVIDIA, that their portfolio is diverse enough that they'll be able to capture enough market share in this growing market that it'll benefit them in the long term. The other piece of news that we got this week, the massive piece of news, was the Fitch downgrade. So Fitch downgraded the United States government credit rating on Wednesday in the overnight session. Fitch is one of the three major credit ratings in the United States, and so obviously this is a big deal. They downgraded the United States credit rating from AAA, which is the highest rating, to AA plus, which is the second highest rating, on what they call a stable outlook, citing, quote, "expected fiscal deterioration over the next 3 years and high and growing general debt burden and the erosion of governance relative to AA and AAA rated peers over the last 2 years. That has manifested in repeated debt limit standoffs and last-minute resolutions. The reason that this is important, right? This matters because the United States Treasuries, a $25 trillion market, a market often seen as risk-free. The market is seen as risk-free because of the United States propensity to deliver on their IOUs, right, over time. The United States propensity to pay back their debt, really has been one of the highest rated, in basically over the last decade, the last several decades. This is the first time that a U.S. credit has been downgraded since 2011, when Standard & Poor's did the same thing following a debt limit standoff. Treasury Secretary Janet Yellen said in a statement the change by Fitch Ratings announced today is arbitrary and based on outdated data. While this isn't expected to have an immediate impact on financial markets, we obviously saw the futures gap down in the weakness yesterday in the market. Again, juggling some other news, not just this. Several earnings came out, and you had jolts, and there's a bunch of things at play. But the market did gap down on this news when it came out. And then J.P. Morgan CEO Jamie Dimon actually threw in his 2 cents. Ryan, if you want to play that clip for us.
It doesn't really matter that much. The markets decide. It's not the rating agencies who make these big decisions. Number two, they point out some issues which we all knew about our debt ceiling crisis and things like that. But number three, most important, the American public, this is the most prosperous nation on the planet. It's still the most prosperous nation on the planet. It's the most secure nation on the planet. And I would point out to the rating agency, that there are a bunch of countries rated higher than us, like AAA, but they live under the American enterprise military system. To have them be AAA and not America is kind of ridiculous.
So Jamie Dimon there is essentially saying that the downgrade is a bit arbitrary in the sense that when you look at some of the comparisons, who are you ranking higher than the United States in terms of credit rating? And I mean, his argument sort of makes sense. If you're going to rank somebody higher than the United States in terms of their credit worthiness, and at the end of the day, their security and protection depends on the United States, it really does not make a ton of sense to see that move by Fitch there. But I guess we'll have to see going forward. They did say that, look, this is not like an end all be all. They did lay out laid out several basically steps the United States could take going forward to get a positive rating action at the agency. One of the things obviously would be a sustained reversal of the trend and deterioration of governance. And so when they talk about governance, they mean, this whole debt limit standoff, waiting to the last minute to approve a new debt limit, things like that. They don't want to see that anymore, as well as some other layers that they put in there addressing rising mandatory spending, with Medicare and Social Security. They talked about, coming up with actual concrete plans to address some of those fiscal issues that are going to come around, the corner very soon here. And so, again, it is not an end all be all sort of move by Fitch there, but definitely something important that, the markets are reacting to this week. Mander, what do you got?
I think Jamie Dimon makes a really good point in that I saw, according to Fitch, there are actually 10 or so state treasuries that are still rated AAA, but the whole holistic U.S. Treasury is now downgraded to AA+. You're going to tell me Georgia has less of a chance of defaulting on their debt than the entire country of the United States? It's in the United States. So the whole thing does seem really arbitrary to me, to Jamie Dimon's point, and we haven't really seen markets move too much off of it. We did see that sell-off overnight. Really, we've been seeing more so in the debt field. Obviously, yields are now through the roof. People definitely emptied out some bonds and treasuries off that news. But I think in the long run, this is really going to pan out to be really not much, because as you stated, and Janet Yellen said, this kind of was old news that is now just getting the downgrade from probably 2 months ago is when they started working on this downgrade. So it really is kind of old news. I guess we'll see how it pans out moving forward. But the one thing I wanted to cover from last night, Amazon and Apple. We finally got the last two of the giant tech earnings coming out last night in Amazon and Apple. And while at the surface, you could say these two companies seem to have very little in common, they share a lot more of a business model than they differ, in that both companies need to move massive quantities of goods and service to kind of justify their valuations. These are some of the biggest companies in the world on paper by market cap. And so with annual revenues now combining for more than $920 billion, these are companies that always have to be looking for the next big thing to drive sales, which can really be hard to do. These make up 2 of the top 6 companies by revenue in the entire world. And so to keep pushing forward that growth is really, really hard, as we've seen with Apple. But I'm going to start with Amazon, because Amazon had the better of the two. Amazon had posted single-digit year-on-year revenue growth for 5 of the last 6 quarters, which is down from that mid 20% range of growth that we saw even before the pandemic sales boom, when everyone had to start ordering things online before that, they were still in that mid 20% range of growth year over year, when Apple recently was in a decline for the past 2 quarters with a negative growth year over year. But Amazon just turned the corner. Apple did not. Amazon just reported growth of 11% year over year on revenue, which was about a $3 billion beat of expectations of around a 9% growth year over year. Revenue beat projections across every company segment, and especially the ever important AWS cloud service that really drives that Amazon valuation as they try and push further into battling with Microsoft Azure, Google's corporate domain. I forget what they call theirs, their Google Cloud. AWS beat across the board, as did every single company segment. EPS came in at 63 cents versus a 35% estimate, which is an 80% beat, and up 530% year over year. Just a year ago, they posted 10 cents of EPS on the quarter. They just posted 63. But the bigger surprise, and I think this is what really drove Amazon stock trading up around 9% in pre-market here, was they almost doubled operating income on the quarter. They posted operating income of $7.7 billion, which was a double from the same period last, and beat analyst targets by 58% on the quarter. So Amazon through the roof. We take a look at Apple, which on the surface also had a double beat. They beat on revenues and they beat on EPS, but this one got more so that Microsoft reaction and is still down about 3% in pre-market here, with revenue falling 1.4% year over year to $81.8 billion. So revenue actually down on a year over year basis. And although it beat Wall Street's projections, iPhone sales, I think, are what really is dropping this one. They beat on revenues thanks to their corporate service arm that they've been pushing, but iPhone sales fell short of projections in what is typically the weakest projected seasonal period, as they always release the new iPhone in Q3 of the year. So even on projections of the weakest period, still missed on iPhone sales. Also projected overall revenue decline for the September quarter coming up, which missed projections. So they're saying they're going to see revenues about the same as this year, this quarter, next quarter, which obviously was going to be well under projections. This is typically the quarter that Apple does the least business of the entire year. That obviously drove Apple gains down, and also made 4 straight quarters of revenue declines, which is a streak not seen by Apple since 2001. So in my opinion, it kind of seems what we said at the start of the week when we were looking at where all of these companies could land. To me, it seemed that some of these companies in Microsoft, in Apple, that were trading at or very close to all-time highs, these companies are getting value now thanks to the generative AI push that we've seen with NVIDIA, with a lot of these AI companies. Apple actually hasn't. I'll get to that in a second. But Microsoft and Apple trading at all-time highs here. Those ones were really priced for perfection, where they were really going to have to beat and mostly guide up moving forward into next quarter. But we had Microsoft, a narrow double beat, and then said they were going to be increasing CapEx for the next 4 quarters. You had Apple with a slight beat on this quarter's projections, but then said they're going to see revenues next quarter the same as they did this year. This quarter, those ones were going to be the tough ones. But I think when you look at Google, when you look at Amazon, some of the ones that hadn't seen the push, although they've outpaced the NASDAQ, they really haven't seen that push that some of these ones at the very top have seen. Those ones obviously were lagging in valuation and had that potential to surprise beat to the upside like we've seen. So the last thing I wanted to say, Tim Cook got asked and said on the earnings call anything about generative AI. What are you guys doing in this space while it looks like all of your competition is really taking away with this? He said, as has been our MO for the past decade or so, we've been working on generative AI for the past 4 or 5 years here, but we're not going to discuss something until it's ready to hit the market. And so don't count Apple out of the space, but as they typically do, until it's ready to make them money, they're not going to talk about it, versus Microsoft, which isn't going to be making a profit for a year, already driving up their valuation with it right now. What was your take from it?
I think it's definitely interesting on the AI front, because they're more of like a consumer facing company, whereas like Microsoft, you can do a lot of B2B business with the generative AI stuff, and obviously NVIDIA, it's primarily B2B as well. So it's definitely an interesting angle if they're able to get it right. And I think if anybody can get it right, it's going to be them. I mean, they have a history of getting things like that right. And so I am definitely excited to see what they come out with. I will say the iPhone sales is not like troubling, because I mean, they're, again, this is supposed to be the weakest quarter. They have the new iPhone coming out next quarter, and I think iPhone sales growth is projected to be like 6% next year versus like the minus 2% drop that we got this year. So if you're an investor, it obviously uncomfortable, but I think if you look out into the future, you'll see that they're expected to rebound, and this is not going to be the end of the world for them. So from that standpoint, I don't hate it. But I mean, when you put the two together, obviously Amazon definitely had the better earnings, particularly on the guidance front, right? I mean, Apple, guided down revenues for Q3. And so between the two, definitely like the Amazon earnings better. And We'll have to see how the price action plays because, I mean, even AMD, we saw the massive gap up. And, I mean, the contents of the earnings were very different. I mean, AMD really, like, they barely beat. Like, they got pretty lucky, actually, that they beat. I think they beat EPS by, like, 2 cents and beat revenues by, like, 100 million on 5 billion of revenue. So, I mean, pretty thin margin there. And then the guidance, obviously, they got it down for Q3. So obviously different earnings there, but same, sort of price action reaction. You got the pop in the pre-market and then ultimately sold off throughout the day. That day happened to be like more of like a risk off day. So I guess we'll have to see what the general market price action is. And I think that'll probably give you a clue on what Amazon will do today. But yeah, between the two, definitely better earnings from Amazon, without a doubt.
I think it's felt like the takeaway from this whole earnings season has been with the market getting so frothy to the upside. It feels like even with these companies, we pretty much saw double beats across the board from pretty much every major company. And yet it really came down to that guidance because people were already kind of in that, should I be taking profits? Is this getting to that point of a little bit of a risk off and wait for a pullback? And it looked like unless you were guiding up for the next quarter, that's pretty much what we saw, is that even on double beats, we were seeing companies down 2-3% in pre-market the next day.
Yeah.
Well, that'll do it for us here at Fed Forecast. We'll come right back to us and give it over to Noah here for Bet the Bell.
Yeah, let's do it. I'm gonna take over Bet the Bell today. With Snipes out in Dubai, I've got to go in for you guys. Do we have stats, Ryan? Should we pull up the stats? We don't have stats, so don't even worry about it. All I know is that I'm in the lead, but we'll start today with green or red. I'll go first. I think that we can get a green day out here. I mean, you saw ES or the S&P and the Nasdaq both trade into support yesterday and close above. Obviously, the news this morning is going to make things a little bit more difficult and volatile, particularly at the open. But I'm still leaning green on the day after what has been a pretty risk off week. Let's see a retracement back into the weekly range, or at least that's what I'm hoping for.
I was going to take this either way. Now it's going to seem like a strategic play for my rankings, but I'm going to take green as well. I think the dip gets eaten up in Apple here, as has historically been the trend. When you see a gap down on Apple earnings, typically it gets at least bought up back to par from the day before. And so I think should that happen, you have Amazon kind of leading this charge. Could get a squeeze of a lot of the recent shorts we've been seeing in Microsoft and Google. So I think tech kind of leads a little bit of a push here on that retracement, and we get a green day.
I love it. That makes sense. That makes sense to me. Let's go to question 2. So question 2 is going to be, given the recent rally in yields. Right now we have the 10-year over 4.1%, which is the highest of the year, if I'm not mistaken. We talked about this in Fed Forecast on the back of the Fitch downgrade. We saw really a muted reaction in equities, and I think that's really because we had so much news still to come down the pipe. I mean, with the Amazon Apple earnings, NFP this morning, you saw it a lot to digest there in the market, but yields have been absolutely on a tear over the past couple of days, and really were on a tear before this decision. So given that, and given the fact that yields and stocks obviously tend to be inverse, when yields are going up, you expect stocks to go down and vice versa. Given the recent rip in yields, what are you seeing going forward? Which one do you think cracks first? Which one do you think gets a pullback first, the indices or the yields?
So I'm not going to say it. I guess it depends how we define pullback. I think if anything, we could see a slight dip. I think the Nasdaq fell like 3% from peak to trough at that Wednesday low there, somewhere around 3%. Which, if we're going to classify that as a pullback, I guess that's what you could see. But I
want 5% off highs. 5% off highs. Remember I told you back in June, we haven't had like a 5% pullback literally since I think like we've just been ripping. Yeah. So I want 5% is what I'm going to call the pullback, and for yields I'll call the pullback under 4% for the 10-year, which is currently at like 4.14 or something.
I'm going to take yields getting back under 4% first. I think if anything, we're seeing this rally off of really, we're starting to see that profit taking coming out of stocks, but I don't think the bullish sentiment has fully left yet. Even on the sell down, we've still been seeing pretty volatile pops to the upside. It's not like we're seeing a full risk off, really like we got accustomed to last year. And so I think, we're pretty much trading at year-to-date highs, getting close to that 4.3 from last year's highs. I think if anything, we start to see a pullback in yields as the Fed really gets to the end here of their tightening curve.
Looking at the market, I should have structured the question better, because like you said, NASDAQ currently is already 3.5 off the highs at exactly where we're trading right now. So 5% would be what? 15,261. We're trading at 15,505. That'd be like another 250 point drop, which is actually like pretty reasonable, I would think. For the S&P, it would be like a much steeper drop, which you would need it to come all the way down to 4,400, which I don't see. Not the S&P, futures rather, which I don't see as reasonable. So if we're talking NASDAQ, I'm going to take the equities pullback. If we're talking the S&P, I'm going to have to side with you. I'm going to take the 4% in the 10-year. I think that's a decent bet. All right, last one. Do you think that the first half of 2023 leaders continue to charge into the end of the year, or is it time to start diversifying gains? We've seen the Magnificent Seven, as they're called, Microsoft, Apple, Google, Amazon, all of those mega cap tech names really just lead the charge throughout the year. You've even had some people saying that those are the only stocks that are performing well. If you look at equal weight indexes, they're not up nearly as much. Do you believe that those names will continue to lead into the end of the year here, or do you believe that it is time to start looking at some of those names that haven't gotten as much love off of the lows? I'm talking about your high beta names. I'm talking about maybe even some of your more cyclical defensive names that really have been underperforming, but given the Dow's breakout in the last several weeks here are starting to show some relative strength. Do you think that those names could potentially lead into the end of the year, or is it going to be more of the same with Microsoft, Google, Amazon, Apple leading us to new highs?
I think it's time to diversify. And I think if this earnings season showed us anything, it's that, in that you have these companies like we just spoke of giving great numbers across the board on the surface level, but because they didn't guide higher, they're not seeing that continued pace of growth that is pretty much getting priced into these valuations. So I think if anything, these tech names probably hold flat or slightly up, but I still think we get that outperformance. And really, since we brought up whatever it was in June, IWM versus QQQ, and we were kind of saying that spread trade, IWM's been up 7% in that same time. And I don't know what QQQ is up, but it's down now like 3.5% off of highs, like you just noted. So yeah. I think we do start to see that rotation. This earnings season I was already feeling that way. This earnings season really just drove it home to me. I think if anything, industrials, utilities, like you said, I think the Dow was just on a 20-day win streak, was it not?
It was, I think it peaked at 13.
13. So obviously you're seeing that rotation. Industrials are cyclical names. High betas in the IWM financials have been poised really strong. You're really starting to see strength in a lot of places elsewhere, just not tech right now. And so I think the ones that got us to where we're at, probably par gains or trade slightly higher into the end of the year. But I think you have a much better risk to reward in some of these other names that have been beaten up and haven't rallied yet.
I agree with you that you do have a better risk reward in some of those names. I will also point out, though, that if we were to have like a down market in the latter half of this year, right? Like for whatever reason, I mean, the recession is expected to begin by some economists in Q4 in the United States. And so my thinking is that if we were to get, some sort of sustained sideways or even pullback action, I would have to imagine that those names would still fare better than some of the high beta companies that we're seeing. I mean, absolutely rip here. I mean, Rivian is up like 50% in the last like month or something. Like you have a lot of these high beta like growth names that are really explosive right now. And if the bull market is to continue, then I definitely see your point. But I think if the market runs into some turbulence in Q3, in Q4, I can't imagine seeing the leaders really retrace significantly, like depending who you're talking about, right? I'm talking about like the Apples and the Amazons of the world, like NVIDIA, yeah, 400% off the lows. Like, yeah, I could see that one coming down, a decent amount. But I mean, Apple, Amazon, like I can't see them dropping significantly, even if we were to have, a sideways to down market in the second half of the year. And if they did drop significantly, I would have to bet that some of the high betas would drop even more. I mean, if you want to talk like Magnificent Seven defensives, it's a little bit of a different conversation. But I think I'm gonna go with the large caps here to outperform to the end of the year.
I would put it this way. I'm not looking to short tech, but I think if I were looking to open new longs, it would be outside of the Magnificent Seven, unless we did see a pullback like you're stating. If we did see a Q3, Q4 decent pullback off of highs, then I would be looking to buy the dip on them. But longing at the highs is not a trade I'm looking to take right now. We'll put it that way.
Agreed.
All right, let's take it right over to Market Moron then. We have our little video.
Did we ever have
Come on, you can't forget that one.
It's been a minute. I missed that one.
All right, so I found this off of Reddit. Well, Ryan did for me, and I thought it was perfect. So I want to hear your take on this one. So guess what I did? After seeing some shit banks bounce back, I bought $4,000 worth of calls on PAWC, only for it to dive after news if it's purchased. I was also down 70-ish% in that trade, but I had a hunger trading more than a few $100s. So I took out a small personal loan that was advertised on Credit Karma from Discover. It was worth $16,000 at a 13% rate. I put it all into PayPal, lost money, pulled it out. I put half into Lucid, lost money, Shopify, lost money. I was so scared to keep losing that I kept selling credit stocks, which bounced back up, losing money on upward trending stocks. I was down to 14,000 from the 16,000. Then I held overnight overstock calls. They bled me, so I sold. It popped the next days. I was down 3,000, 11,000. Bought Vroom last week, dropped 9.7K. Bought Lucid today, dropped 8.6K. So he's now down from half the loan. He got a $16,000 loan. He's at 8,600. I don't know how to pay back the loan now. And I just figured out you pay interest during the loan, not at the end. So the ending there was the real kicker to me. I don't know what kind of loan this guy thought he was getting, but thought it was a zero note or a zero coupon treasury here. He was going to have to pay no interest until the very end. But I wanted to get your take on this because I've been seeing, a lot of people do this. They see the potential of trading, and instead of getting good at trading first and then leveraging, they leverage hoping they're going to get good at trading. And now he's sitting in $8,000 worth of debt. He said he was trading with a couple $100, so it made him think he was going to go get $16,000 and become rich.
Yeah, that's insane. Well, first of all, the ending there, Ryan, can you throw that back up? The ending there. I just figured out you pay interest during the loan, not at the end. That's crazy. That's absolutely crazy. We can start there. Like I don't know if that's where you are, and you're, and like this is not like a make fun of him for like not understanding. It's more of like if that's where you are in terms of like your financial understanding, you probably shouldn't be taking out loans to risk it in the stock market. That's that, right? Secondly, it seems like he's just had really bad luck. I mean, because when you look at like some of the names that he was playing, I mean, PayPal, like I know so many people who we're kind of in the same boat, like really believed in PayPal, and it's a great one to talk about because I mean they had earnings yesterday, dropped so fat. I mean, what are they down? Yesterday lost about 12% on earnings. Like this is one of the names that throw it in like that AMD basket that you see the market rallying, particularly the indices, right? You see QQQ outperforming, and so you go, okay, let me go into tech and see what hasn't like gone yet, so I can jump on that train. You look at AMD, hasn't really run yet. You look at PayPal, hasn't really run yet. You look at Lucid, right? Tesla ripping, Rivian ripping. Lucid obviously has to be next, so I'm going to go buy some Lucid. And then what happens? You get a situation like in AMD where the stock is literally flat. You get a situation like in PayPal where they absolutely just got a 12% haircut on earnings. And you get a situation like Lucid where they're just showing relative weakness relative to the rest of the sector. That just sounds like bad luck to me, to be completely honest. And you hate to see that. But one way to avoid a situation like that, even though, we all have bad luck sometimes. I have bad luck sometimes. I don't take out loans to trade. So, that is probably where you would want to look for, to avoid something like this. Trading is hard enough with your own money. There's no need to go and take out loans and make it more risky, more stressful for yourself. It's never the move, really.
I think that was the moral in this story is you never invest or trade money you can't afford to lose. And so obviously you could barely afford to have a trading account to begin with. It sounds like he was down to a few $100 from the $4,000 worth of PAWC call. I mean, let's just talk about that one too. You remember PAWC? PACW?
I actually left I left that one. I completely forgot about that. That's also crazy. Like it's just
I mean, there's one. Like we had the whole banking crisis going on, and he throws $4,000 worth of calls on probably one of the more high risk ones that was out there.
Yeah, the higher risk one that was left. They almost went under like when all of this happened. Like that was one of the ones that they're like, watch out for this one next. And it ended up not going down, and people were like, all right, like maybe they're okay. And then it came out last earnings that they're going to get, or they're merging with like Bank of California or something like that. Yeah, that's terrible. I mean, it is tempting, I will say, like, especially when you see some of these names that First Republic is a good example. So like First Republic obviously went under, but like when you initially saw that drop, if you like sort of looked into it, didn't really fully understand the extent of the trouble that they were in, I can understand you wanting to buy some First Republic. And you know, the company before all of this happened was a great stock, like a really sound company, to be completely honest with you. Um, and so I understand that sort of, you know, that want to buy or want to get a deal, right? Like, I mean, that's the nature of the stock market, right? At the same time, leveraging it using a leverage product like options, and then giving yourself a finite date by which the stock has to bounce, it doesn't seem like the right way to play it. And that obviously in hindsight was not. But yeah, you know, that sounds like a bad beat for this guy. I'm wishing him the best. Hopefully his next one hits. Or maybe what he should do actually, he should open up a fintwit account and become a furu and just sell picks, and everybody can just fade him like the Trent guy on TikTok, and he'll make his money back that way through subscriptions. I think that is probably his best course of action. That's the recommendation that I would give.
At the end of the day, it sounds like he's really deep in the hole, probably in his head. But listen, down $7,400, you can always go make more money in the course of your life. And so hopefully it was just a lesson learned. I'll send it right back to you for trade of the week.
No trade of the week this week. We're over time.
Look at us, we're over time. All right, well, that'll wrap us up, guys. We'll be back Monday at 8:30. Hope everyone has a safe weekend, safe trading today, and we'll see you guys here on Monday.